go ahead and get this started. Awesome. We should be recording now. I just want to say hi to everyone and welcome you to our week 3 team meeting. As you all probably noticed this week, we've started to kind of shift gears, right? Not just looking at the market itself, but the actual tools inside of it. So when I listed this as key financial instruments, to me, what this means are the vehicles, right, or the tools, what is actually being traded within the market. So deep dive into the ETFs, bonds, REITs, different volatility instruments, and a little bit beyond that. Before we do continue a deep dive or the debrief into today's conversation, if my question to you all is if you could build a starter portfolio with 3 of these instruments that were covered, what types of instruments would you pick and why? And if you all are okay with it, I can go ahead and start us off. Personally, I of course would pick SPY for the broader market exposure.
Yeah,
When I
same.
when I think about um, that, then in relation to at least current market sentiment and what we're seeing develop, I think for me, depending on what we're seeing exactly with like tariffs being hiked or potentially reduced. So when I hear conversations like de-escalation, with China potentially in the past week, although those conversations haven't been had. I think about opportunities like TLT, right, for a little bit more stability as we continue to see inflation rise. A great opportunity over the past, surprisingly, over the past 5 or so years now, has been gold, right? And this to me has been a very tricky trade. I haven't been able to necessarily execute any trades on GLD or to hold this, right? For me, it's been more of getting an opportunity to actually buy physical gold and seeing the price of that rise over the past few years as inflation keeps rising. I don't necessarily have like a whole ton, right? I don't have like hundreds of thousands of dollars in it, but it was just a pretty neat opportunity to for myself see or have something like physical that I've seen grow over the last few months even, and just a great opportunity to start diversifying myself and feel comfort in knowing that there are different things of value that I can potentially pass on to those that come after me, because at least on my end, that's one of the biggest things or my biggest hopes or drivers in doing everything that I'm doing beyond just teaching others and passing on this information is being able to leave something behind for family members or those that end up coming after us. And we'll go ahead and go into some of the just a breakdown of the objectives that we were looking to go through this week. Um, some big takeaways, right? As far as being able to identify and define a lot of these instruments. I know that they are things that a lot of us are probably already comfortable with. We see them pop up recurrently. Things like again, ETFs, the bonds, the REITs. We to some extent have heard these, but what are they actually, and how are they potentially useful to your specific situation, circumstances that you find yourself in? So that to me was one of the biggest things to emphasize or to stress throughout this specific lecture was to have that understanding of how do you start building an overall structure for yourself when it comes to thinking about executing and the types of opportunities that you get within the market. Some of the guiding questions for me as I put a lot of this lecture together were things like what stands out about ETFs and things that I might have not necessarily known before. I think that for myself, one of the biggest things is that ETFs aren't just cheaper than options like mutual funds, right? They have the potential to trade throughout the day and really make it more flexible for you to be an active trader. But with that understanding, also the understanding that there are some fees behind ETFs, right? And understanding how do indexes work and what are these entities that put them together, right? That's something that I didn't necessarily do a deep dive in within the lecture content itself, but it's something that I will encourage you to really look into is who are the entities behind these ETFs, right? When you think about Qs, the overall in or the biggest indice when it comes to tech, who's Invesco? Right? Who is the organization or the people behind the organization that have put together this tech ETF and maybe dive into why they decided to do that. Did you know that Invesco has a bunch of other ETFs? They have specific ones related to, they're kind of like spin-offs, right? Of QQQ, but things like self-driving invest ETFs, things like renewable energy, the different types of refined or niche ETFs that narrow down the conversation within QQQ itself. So it's a great opportunity to build that understanding for yourself. I think about another one that wasn't necessarily brought up, but TAN, right? Energy or renewable energy specifically holds a lot of solar power companies. To me, that's definitely of interest. Not just because of the potential and the types of innovation that we see going on currently, but just overall interest, right? And myself, we've talked about within the group my family's intent to build our own home, right? So when that comes around, well, are we going to consider solar? How can I make sure that this isn't just a product investment, but if I'm going to make use of this and I see a lot of other people making use of it as well, how can I benefit from the understanding of what are these companies and what are these ETFs that they put together and how are they beneficial? So that's something to keep an eye on or your mind on when you start to dive into a full breadth of what are these ETFs really beyond just SPY, Qs, IWM, and just that general understanding of what they do and the fact that they are, or that we have the ability to trade options contracts with them or to hold their shares. I was also looking into what are the major differences between ETFs and mutual funds that really matters when trading or investing? One big difference is the liquidity side of things, right? Where we touched on it a little bit, where ETFs trade live during the day, it gives you the opportunity to get in, get out whenever you want or whenever market is open, right? Whereas mutual funds are only at the end of the day when you see that like renewed value. So definitely something that I want to consider when I'm thinking about building out my overall portfolio, right? Beyond just the shares or the stocks that I've gone out myself and bought. When I think about the fact that my current employer has a 401k benefits package, right? When I start to think about how can I be more active in that sort of investment process, or my willingness to um, really figure out how can I have a diverse portfolio? Because yes, I can go ahead and let the management company that oversees my employer's benefits, or my specific benefits within the organization. I can let them handle all of it, right? Or I can say, hey, these are the things that I'm specifically interested in beyond the instruments that you all are already buying me into. What are additional opportunities? What does it look like to potentially consider X, Y, and Z? So that's one of the big hopes that that I'm looking for you all to develop an understanding of as well, because I know that a lot of us are invested in one way or another, and I know that a lot of us might already have reached a lot of these opportunities, but are you fully in understanding of what they are? And in addition to this, when I take a look at, again, current market conditions, am I more likely to hold TLT over SPY, or am I going to look into different ways to hedge my current investments? Am I looking to go cash? What are the different opportunities available to me, right? Why was I willing to sell out of the majority of my portfolio between early January to about early to mid February, right? We touched on this in early sessions. If I'm not mistaken, it might have even been our first team meeting when we talked about the fact that I was very fortunate that in those early months, my portfolio had actually hit right around. I don't know if it hit exactly that 20% year over year, but it was around that mark, right? So definitely, to me, seeing a lot of these things play out in the conversation that was going on, my thought was, well, if the goal, if the current administration's goal is to reach a certain interest rate percentage, or to do all of these things that they are telling us that they aim to do, then something needs to happen. And that something was the fact that the market, stock market, needs to go down for a lot of these things to occur, because a lot of the conversation that was going on, if the market didn't go down, then a lot of these things either wouldn't happen, or inflation was just going to run rampant, right? So in my mind, I was thinking worst case scenario, and I had the feeling of, well, this is not going to be a soft landing at all. It's going to be very hard. And worst case scenario, we might go into some sort of current day depression, right? With just the retracement that I thought had to happen in order for a lot of the this conversation to come to fruition. So lots of things that go through my mind when I think about these different ways to hedge and really protect myself and my investments, and then having an understanding of how do you leverage ETFs, and why do they even exist, right? If they're so risky, whether you're trading a leveraged or an inverse instrument, why are they there? Right. And if they have such risk, how can I potentially turn that in my favor, right? If I see current conditions, if I see an opportunity, is it possible for me to go into something like TQQQ? Or do I potentially see it going against me? If that's the case, is there an opportunity to get a little bit more um, innovative or creative when it comes to my options contracts? Can I potentially do some sort of a butterfly or bracket, a trade, right? Not necessarily concepts that we've gone into just yet, but concepts, again, that I'm excited to build into, because this is where the conversation starts this week, in understanding these instruments. And then further on developing the understanding of the contracts behind these instruments and the really the fun and creative ways that you can make money, right? When there's uncertainty, because at the end of the day, especially when you're taking a look at the options market, a lot of this is rooted in or it's feeding from volatility. There was about not a whole year span, but maybe like I want to say 6 or so months. About this would have been maybe like in the end of 2022, start of 2023, if I'm not mistaken, where I traded very minimal amount of options contracts. And that's what kind of shifted my understanding or my realization that I really needed to hone in on what are the actual instruments and how are they moving and how can I trade them? Because at that point in time, that's when I think it was like October 2022, where you got to see the additional spike in the tech industry itself. It's when Facebook had hit its low in years, and then it just ran up for like a whole year or so. At that point in time, you saw options contracts become ridiculously expensive. And when you took the time to analyze what price is a contract, right? When you're talking about the theta, the beta, and all of these different things that play a role in an options contracts pricing, and overall your potential gain or loss, it was that realization that a lot of these instruments were overpriced, at least options were specifically, and it didn't financially make sense to risk that much money to have minimal outcomes in comparison to in previous years, right? If I think about even the first year that I actually started trading, it was insane, right? With the fluctuations that were happening, especially during those initial like COVID closure, that initial year, really. It was insane as far as the how pricing would change. And this all has to do with things like overall volume and that leading into volatility, right? And I say this because I'll post this in the group, but I remember my very first significant or large trade where and it was specifically there was actually three of them that I'll show you all. It was Fubo, PLTR, and oh man, the third one's escaping my mind. But those were the two ones that initially come to my mind where I entered right at market open, right? And not necessarily having a full understanding of the market itself at that point, but entering right at market open, got a contract that was maybe like I want to say for PLTR, it was like two or so, or maybe even $5 out of the out of being in the money. And within a 50-cent increase of the price strike, um, or my overall contract, the contract went up $350. Within a dollar move, the contract was up like $850, right? And to me, I was like, oh, amazing. Like it closed out right away. To me, it was insane because I held that contract for maybe at most like 3 minutes. And in my mind, I could not understand how I essentially made, if I was thinking at that time, what I was making hourly, I made like 2.5 days worth of my paycheck in about 7 or so minutes. So to me, that was insane. But now trading in today's environment, it's a lot different because of what we're seeing and the overall the fact that there isn't as much volume in today's market as we had in 2020. Do you all realize that, or have you had that understanding just yet? If you've taken a look at overall volume, which is something that I really encourage you to consider on a day-to-day basis, you'll start to see like what those averages are, and it's substantially less than what it was in 2020. Reason being is that in large part, a lot of the individuals that were part of the market or that were trading on a day-to-day basis or that had some sort of investment, whether it was long term, a lot of those people have unfortunately been wiped out. Right, a lot of that influx also came from the relief funds that we were receiving, right? A lot of people chose to trade with that money. They chose to put it into the market overall. So you saw a huge influx of money. So yes, to my understanding, it was an artificial inflation, right? Because that money was given out by the government with the understanding that these people are going to use that money probably in the markets, or at a minimum, they're going to use it to buy goods, right? And we'll do a deeper dive into all of this when it comes to the flow of money and why the printing of money has certain effects. But all of these things play a role in this conversation when we take a look at key market principles, or overall just the relationships between these key market instruments. One of the most important parts is again that interaction between all of these. When I take a look at things like SPY versus, and let me actually move forward a little bit here. When I think about things like SPY versus VIX, right? Does anybody know that relationship? Just bare bones, like off the bat, do you have an understanding of that SPY VIX relationship, or SPY and the VIX is the volatility index?
Yeah, the volatility. It moves like inverse, moves like opposite of SPY,
Yeah, definitely.
in a way.
Yeah, that's exactly what it does. It is an inverse relationship. And that one I wanted to highlight because it's one of those where it's always going to be an inverse relationship, right? So I bring that up specifically because there are relationships out there that do change over time. So when we take a look, and the reason why I didn't necessarily do like a breakdown of a relationship between SPY and Qs or SPY and IWM is because those change very frequently, right? We'll have days where you see tech bleeding, but SPY might be red as well, but it's holding, and it's not necessarily bleeding as bad as tech. And you think, well, the biggest companies within the S&P 500 are tech companies. Why aren't we completely flushing on SPY? But then you take a look at IWM, and IWM is actually green, right? And it's running on the day. So it's the realization that there are a lot of different factors that play a role in market movements, and day to day these relationships might change, but that brings an opportunity to potentially execute a trade, right? Because it's the understanding that the SPY is heavily tech weighted. So if we're seeing Qs have a day where it's just bleeding, right? It's creating a staircase down, like what we've seen the market do the last few days or weeks, but you see IWM just running all day. What happens, or what opportunity comes when Hughes is still doing its thing, it's creating that step ladder down, and IWM reaches a peak and you see the volume start to die off? It's that opportunity to then potentially short SPY, right? Because your understanding of that day could have potentially been that IWM, the Russell 2000, right? Small caps was essentially what was holding SPY up. So it brings the opportunity when that factor that was holding SPY up specifically starts to slow down, or it starts to reverse, then you can that could potentially be a trigger, or a point where you might consider shorting SPY. right? Or you will have days where they're all moving together. The whole market's just bleeding as a whole, or they're running as a whole. As we saw on Friday, I let you all know I had to close my charts, right? Because it just it looked very easy to trade on Friday because the whole market was moving together. SPY, Qs, IWM, they were all in conjunction with one another. So they saw retracement together. I did see that IWM was leading. And I say this because, again, that relationship will not be like on point by the cent on the dot, but overall those movements happen together. But you would see on Friday IWM would be the one that gets the initial pop, and then SPY and Q would get that pop maybe a minute or so, 30 seconds or so after IWM initially would have its first reaction. So for me, I didn't trade a futures contract until about, if I'm not mistaken, around like 9:30, maybe 10 or so Pacific Standard Time. So this was about 3 hours into the market. At that point, I had seen the overall trend build up, right? And that relationship within the charts building. So it was really like a 15-minute watch of the market, and then that realization that, oh, it looks like IWM might be leading, right? It might be running ahead. So let me test this theory, right? So I was able to execute yes off of that, but towards the end of the day, after I think I had a total of 3 trades, the realization that, man, okay, the trend is there and it looks like it's going to keep going. It looks like we're going to get another sort of pop. But I just also need to call it good, right? That's more of like a side note in wanting to also develop the understanding that a lot of these relationships will pop up day to day, month to month, week to week, whatever it might be. But there isn't a need to feel like you need to catch the whole move, or that that relationship's going to keep happening, or that it's going to exist through the entirety of your specific trading session, or like I said, week, month, whatever it might be. Some other things that I wanted to include in this week's lecture that I am still developing a greater understanding for myself are commodities and the currency ETFs, right? And a lot of this was emphasized this week when you hear conversations, and I don't know how in depth you all follow the politics side of things. But I think right around like Wednesday or Thursday at the latest, there was a conversation that was going on, and it was one of the French government officials that said that he wants other European countries to back him in wanting to remove the dollar, the US dollar, as being the global reserve currency, and bringing back the euro into that position. And a lot of that conversation comes through what's going on right now with tariffs and um, the overall devaluation of the US dollar, right? I'm not sure if you all necessarily follow the dollar valuation or any indexes that follow that, but the dollar has been losing a lot of its value in the past months, yeah, and years, really, right? Since especially as we stressed our own finances when we started to print substantially or introduce additional money into our pool, um, that has been a topic of discussion or like a topic of concern for global government. So with that understanding or those conversations popping up or being emphasized throughout this past week, for me, it was really great timing to be able to, again, dive into it and that understanding of what are those interactions looking like when the UUP or DXY that also tracks the dollar, when those things are fluctuating, how can I potentially still cover myself, right? If I'm thinking about not necessarily storing money in the markets through shares, but if I'm wanting to hold cash reserves, what does that look like, and what's the potential concerns or risks in doing that, right? Because no sort of investment is risk free. Even if you're just holding cash, that overall cash value can be devalued. So definitely a great opportunity to have that overall understanding. And one of the biggest things that I want to dive into when it comes to commodities and currency ETFs is the fact that these bring some of the most insane opportunities, or they might foreshadow really big opportunities that are to come within the market. So again, when we start to think about all of these different things going on at the political, at the government, international level, how does that trickle down into the stocks that you might be interested in trading on a day-to-day basis? Does anybody or was anybody active in the markets right around the time or before we had the Russia Ukraine stuff start to come out, even before like the invasion and war breaking out? Who all was actively trading in the markets?
I was, but I held back a good amount of time on that just for the fact that, yeah, I didn't quite understand the whole picture and what would affect it. But during that time, I think I was only just trading options. Um,
Yeah.
I wasn't really messing with anything else at the time.
Yep. And that was the case for a lot of people, right? And the reason why I bring this up, because I felt so, I don't know how to say it, like I almost like a feeling of paranoia. And I say this because so the official invasion happened on, it was February 24, 2022. So that was what, about like 3 years now? It's literally, we're 2 day or what is this, 2 months and 2 days removed from that happening 3 years ago. So a little bit over the 3 year mark. And these are tensions that are still ongoing, right? But if you take a look at, and I kid you not, I'll go ahead. My goal is to put together a video with this entire breakdown, but I'm trying to figure out how to like structure that conversation. So I'm hoping that today kind of starts that, it presents that outline of how I want to present this to you all in the group. But if you take a look at about a year's out, so about like February 2021, what was going on between then and the actual invasion happening, there was very interesting fluctuations going on between USO, so crude oil, and the dollar. Of course, a lot of this conversation or a lot of the reasoning behind why things were happening or why oil was reacting in a certain way or why was the dollar reacting in a certain way in relation to oil, having to do with what was going on in the Middle East, right? And the fact that there were shifts in oil production or where these reserves were being sent out to, where they couldn't be sent to, just um, the overall exchange of oil and the feeling of we're not going to necessarily cater to the United States anymore, that's where a lot of that started to be emphasized or like stressed, or it became more evident, right? Because this is something, these tensions, as far as we don't want to simply be an oil field for the US, a lot of these feelings have happened or they've been there for decades, right? But it to me, it was very interesting what was going on throughout that year because there was no conversation about like Russia potentially invading Ukraine until about like a heavy emphasis into about like 2 or so months before it actually happened, right? But these things don't just happen. It's not like Russia one day just said, "Hey, we're going to do this," like the day before, right? It wasn't February 23rd and they said, "We're going to invade now tomorrow." It could have felt like that because on our end of the world, we're not always privy or we don't have access to that information, right? Somebody that's in Ukraine, they live this day to day and they know what those tensions look like. So for us, it's always delayed information. But as you see events leading up to it, oil was just increasing substantially over time. So it was a really great opportunity when that conversation started to say, hey, there's actually these tensions going on here. And it was never a, hey, there's going to be an invasion again until like a few months before, but it was the conversation started as far as there's these tensions here and they want something out of this. So whenever there is any sort of looking at historical market points, whenever there has been any sort of build up into a war, especially once a war has happened, oil always increases, right? You need crude oil not only to as fuel, but as production for a lot of things that go into the process of war, right? Overall materials, um, and that will always happen, unfortunately. So for us that were active in the market, you started to see XOM, you started to see Shell, you started to see all of these oil companies just start to increase substantially. So I encourage you to look back at some of those charts, 2021 to now, or specifically 2021 to about the end of 2022, and you'll notice or you'll have that understanding of why those companies increased substantially and why they've remained at where they have right now, and the overall interest to continue to expand not only to fuel the vehicles and the equipment that we use on a day-to-day basis, but the fact that just ongoing political tensions will always bring a necessity for crude oil in one way or another. So for me, it was a weird feeling because I got to benefit from it, right? I made money off of it, but it feels like it could be considered blood money, right? It's very weird, at least to me. But also the realization that, again, we touched on this, if I'm not mistaken, last week. For you to make money, somebody has to lose money. There's always somebody on the opposite end of things. So that's something that also shouldn't escape your mind, is that there's always, unfortunately, somebody that's on the losing end. But again, the whole point between or behind this week is to have that understanding. Um, a more in-depth breakdown will come of that Russia-Ukraine tension and war, and how that specific relationship between crude oil, the dollar, foreshadowed what was potentially to come, right? Nobody could have told you, hey, this is exactly what's going to happen unless you had some sort of insight within government. But the stock market does foreshadow a lot of things, whether it's potential retracement within real estate, right? Or a potential war breaking out, potentially a spike in cocoa beans, right? A spike in different sectors, like all of these things, they're foreshadowed. And a lot of it just has to do with the way that money is rotating because somebody always knows something. We know that the SEC or the SEC tries to mitigate or say that the markets aren't manipulated, right? Or you can't do insider trading, things along these lines. But the reality of it that there's always smart money, and there's the majority of people with the bigger money are executing based off of some sort of knowledge that they have of upcoming events, of upcoming potential stressors, things along those lines. So it's always there's always a reason behind money, especially big money being moved, right? And these relationships that we're talking about throughout this week's meeting, they all highlight that. And that's how you can take advantage of it. That's how you can potentially take a piece of the pie. I remember something it's like a core memory now. And again, not to sound like paranoid or anything like that, but I remember something very clearly back in 2020, right before like official COVID closures were announced and before March 2020 when the US said, hey, this thing that we thought was only present in Europe and the East is actually here. And we're going to have to close down business and we're going to have to do X, Y, and Z. Before that conversation came up, I want to say it wasn't a whole month, but it was maybe like 2, 3 weeks at most before that official announcement came up, where not only was I working at the institution or the organization that I work at right now, but at that point I'm trying to pay off student loans as well, right? I'm still have some, but it was a lot more at that time. So I was also working with some of my family members, my uncle specifically. A lot of my family members work on the construction development side of things. So I remember that we were actually working at a house in La Jolla here in San Diego County. I don't know how familiar you are with it, but that area of our county is the area that holds probably the wealthiest individuals here, right? It's where all of your multi-million dollar mansion homes are, right on the beach. So there's always a lot of development construction going on there. But I bring this up because we were very blessed to be working at this home that was owned by a film exec. I won't go into details, but he runs, or at that time was one of the administrators for a pretty big film production company. I forget what his wife does, but we're there, we're getting wrapped up with the day. And she seemed like very frantic, and the whole day was kind of just like on the phones, and we could hear her, right? Because we're there, like we're in the home. I think at that point we were done with the majority of things, and the inside was just like cosmetic things that were being done. So as she's having these conversations, a few things like stood out to me, just the conversations that were being had. And then after her like spending a day doing this, just telling us like up front, like, hey, you might want to be aware of a few things. Like, just keep an eye open. There's probably going to be a lot of things coming up in the next few weeks, and if you all can finish this project in the next like 2 to 3 day, I think it was like a Tuesday or a Wednesday. So essentially, she was asking us to finish by the end of the week, whereas we thought we had maybe like a full 7 or so, like an additional week left. Um, but we were being asked to wrap up, and she clearly said, I just won't be able to have you here beyond that. it'll be an issue. And also just advising us to think about how we're using our money. She said, like, you're going to get paid. Make sure that you are situating yourself accordingly, because it might be difficult for you to find another project in the next few months. And having that conversation at that point in time, it was so weird. Just not necessarily knowing like what to think of it and just saying, oh, okay, like you want us to finish the project, I guess we'll just like work extra hours, right? And it was definitely doable. We got it done. But then hindsight 2020, right? Looking back at that conversation and the realization that they were probably moving money that whole day, and they probably to an extent, especially being that they were connected to film studios, right? Be having some sort of knowledge that, hey, they're going to shut down and you're not going to be able to produce movies for the foreseeable future until things get figured out, right? At least that's what I think based off of that conversation. But I bring that up just because to me that was like something very personal where I got to see this like right in front of me, right? Like I was the first person understanding to that type of thing that happens, or I don't know how to describe it. But those movements that happen within the market and the fact that these moves are always foreshadowed, they just don't happen overnight. I know that a lot of people like to see the March 2020 drop in the markets as a black swan event, right? Because a lot of people say, oh, like this wasn't like you couldn't have known. Yeah, we couldn't have known on our end because we're not privy to those higher up government conversations, right? But somebody is in one way or another, and there's things out there in the market that could foreshadow. Right. So that I won't go too much more in depth into that, but that's just a little bit about to give you an understanding of where my understanding is coming from and why I really wanted to emphasize all of these types of instruments to be able to give us more of a clear view or understanding of these different instruments. Do you all happen to have any questions about the specific instruments that were covered? Questions between the relationships between these instruments? Was anything unclear? Or do you have any sort of insight in how you've seen some of these relationships play out?
Yeah, I haven't done too much due diligence on this, and so yeah, right now I have like 6 tabs open on doing the research and everything on you know yeah how this all moves together. And obviously, yeah, you hear it in conversations, you hear it when people relocate all their assets, and you're seeing especially with the tariffs coming in, just seeing a lot of money kind of relocating and being adjusted. Like prices of gold and everything like that. So yeah, I am new to this whole kind of thing, but yeah, I got everything open and doing my due diligence.
Awesome. And that's in all honesty, that's all we can do, right? Just definitely sit with the content and the sources and taking the time to figure out how we perceive it or what it means to us and potentially how does that play a role in the day-to-day things that we do personally, because again, I'll keep stressing this throughout the entirety of our year, specifically within this course, is the fact that we're all experts in our own respect, right? So you all definitely have certain understanding of certain sectors, fields of studies, things like that. So as the more you're you're doing a deep dive into these specific instruments, also think about them in relation to what you do on a day-to-day basis, because odds are you'll probably come to a point in time where you'll know something or you'll see something potentially developing, right, or being foreshadowed because of that knowledge that you have. So definitely applaud you for taking the opportunity or the time to start pushing through that. I know that today's or this week's activity or the worksheet that I posted, um, as silly as it might seem a little bit silly, right? Because I presented like different scenarios, like a income stability, like a high risk, high reward scenario, and I asked you to pick one of the like what would be the ideal instrument to help a client or an individual or yourself within this specific scenario, and to kind of detail your reasoning behind it, right? When you think about the income stability scenario, you're managing money for someone that is retired and they don't necessarily care about high growth. They just want steady income with low volatility, right? Which one would you choose? I think it presented options like TLT, O, VNQ, if I'm not mistaken again. Um, and I would personally go, depending on where we like find ourselves, market sentiment, things along those lines. I would actually recommend looking into some sort of realty, whether it's REITs or O itself. I was more inclined to go with O specifically in comparison to VNQ, which is which is the instrument for REITs. O is a specific share or a specific company, right? That does have that is considered like a REIT or has access to the real estate sector. And the reason why I would have been interested in O is because of its current chart and just where it finds himself and where it has been historically, and the fact that you do get also a dividend payout within O itself and the potential for it to continue to grow as well. So yes, you could go VNQ and just say, hey, I'm going to look for this steady like payout. But with O, I see both the dividend and uh, the potential increase in its overall valuation. So that's why I would have considered that one. When you think about high risk, high reward, you're thinking about specifically, I see this in a lot of us when we are starting out. We want to be more bullish. We want a lot of exposure, right? We want those fast movements, but we also expose ourselves to high loss, right? When it comes to that, the high risk, high reward scenario. The only times that I've felt comfortable trading leveraged ETFs are when there was a clear scenario or clear understanding of, hey, the market has ran all day, or there was something that came out in the news, something was said by our current administration, things along those lines that we know the overall market was looking for in order as a reason to push up. Right. So, and I've never necessarily swung shares of these leveraged ETFs, but I've only traded them as a day trade, right? Whether it was just a scalp or an intraday trade. I know somebody that has actively traded some of these held some of these leveraged ETFs like SOXL, Tracer in our chat. I don't know if you'll get to see this recording, but just a little shout out to you. He is definitely I would consider him a close friend, right? We met, geez, in 2020 as well. Um, not to give too much out about him, but he finds himself like in Asia, right? To just give you a general understanding of where some of our individuals find themselves. But I met him, if I'm not mistaken, he was like turning 17. So he's been in the markets like since a very early age, but he gave me a really good understanding of what is the interest behind these leveraged vehicles or instruments, right? And again, that understanding that it brings more bullish exposure, or it essentially gives you, if you're thinking about like in a margin understanding, it gives you more to trade with or more exposure. So depending on those opportunities, overall market sentiment and what's going on. Those bring great opportunities, but typically I would definitely urge you to stay away from them for the most part, unless you know specifically what you are looking to do or what scenario you're going to find yourself in. Let's take a look here. We've covered a lot of these, the overall market relationships, to give us all like a general rundown and debrief as we look to wrap up today's recording. One of the biggest things to keep in mind and that you need to develop a long-term understanding for if you are going to remain in the markets are interest rates versus bonds, right? That's a very prevalent conversation that's being emphasized at this point in time. Ooh, you see that bonds are bought and sold. We talked about this during last week's meeting. What is a bond? What is the essence of it? Why does it exist? The main relationship you have to have an understanding of is that whenever interest rates increase, bond prices decrease, right? Especially if you're looking at things in the long-term vehicles like TLT, which is it's a bond ETF, right? Or IEF. So all of these are closely related to Fed policy and inflation data. So when you start to think about how can I potentially trade these instruments, those are the things that you're looking for rather than the chart itself, right? You don't need to necessarily emphasize as much as like where are the support and resistance areas or zones within these charts. You want to know what the Fed policy is, what is it being talked about, what is inflation data looking like, rising rates, how does this cause a concern, and how does it urge or how does it prompt people to move money in one way or another. When you're taking then having the understanding of how rates impact bonds, then you also need to know how bonds impact stocks. And to that extent, how interest rates impact stocks as well, right? The relationship for the most part, it stays the same. Stocks go down because bonds are going up. When bonds go down, typically stocks run, right? So this is all inflation driven again. And when you start to think about how interest rates are affecting bonds and then bonds in turn affecting stocks, well, how are stocks then in turn affecting commodities, right? When you think about gold and all of these things or vehicles, instruments that are seen as capital preservation instruments, how are all these related? So this does, I hope, paint a picture of that full circle of how one impacts another, and then how does this lead into the overall volatility indexes, right? When you're thinking about VIX, UVXY, all of these different opportunities, they all go hand in hand, and once can potentially spiral or have a domino effect into the others, right? Whether we get an interest rate hike or what conversation have we been having within the past few months when it comes to interest rates? Do we all know? Has the Fed been talking, or market overall, what have they been asking for? A rate increase or decrease?
I think a decrease. Sorry, I'm taking notes like a
Oh
savage
no,
right
you're
now.
good. No, you're good. Like I said, I don't expect you all to have an answer for everything every time. I'm just prompting these questions, and not only for you all, right, but those of us that also find ourselves in the recording. Think about these as we're going through this conversation. Yes, current day, the market has been looking for a rate decrease, right? We want interest rates to go down. We want real estate to be more affordable. But what happens if or when that interest rate decrease comes in? And why has the Fed been so hesitant to introduce that at this point in time?
Wouldn't it be inflation?
Correct. Yeah, it is inflation, because what happens, again, taking a look at, let me move one slide back down, taking a look at interest rates. If rates go down, how does that impact things? So overall, if the interest, if we say rates are going to go down, if we're going to have a cut, and this is also dependent on the amount of, or the cut itself. So when rates go down, it prompts people to, or ideally, not ideally, what the market wants is for an influx of money, right? So if rates go down, there's going to be an additional influx of money. So if rates go down, it's going to then potentially spiral based off of current market sentiment, not traditional relationships, but based off of current market sentiment, it'll cause stocks to run. So if stocks run again, then it's going to bring that inflation that AJ talked about. Right. So that's something that they're watching very closely, because if you bring this conversation back to the beginning of our meeting today, one of the biggest things that the current administration has looked to do, and they will never say or come out and say, hey, we want the stock market to go down, but that's exactly what they've wanted, and that's what they've needed in order to achieve a lot of the things that they're looking to achieve, right? When you talk about decreasing our overall national debt, and that's one of the biggest things that they're looking for, right? Is to decrease as much of that debt as possible. And I mean, current president has said that ideally, in a picture perfect world, we get rid of that, the entirety of that national debt, right? So if that is the goal, then you need the markets to go down. You need all of these things to happen. Unfortunately, it will cause people to lose their jobs. A lot of pain will happen economically. But if all of those things are to come to fruition, the fact of the matter is that the stock market needs to go down, and that's in large part why the Fed and why the administration as a whole has let this kind of not spill, but just slowly bleed out over time, right? Because that is needed. But when that overall, when that rate drop comes, it's going to be a matter of how big of a rate drop is it, and based off of that current market sentiment, whether it's uh, tariffs just still being increased, if we've come to some sort of agreement, de-escalation, things along those lines, that rate will cause things to shift, and very likely that it will just see an influx of money come into the markets. Let's take a look here. We touched on pretty much everything that I wanted to touch on when it came to gold, the dollar, the currencies, leveraged ETFs, time and volatility. oil specifically and inflation effects, right? Higher oil leads to higher data when it comes to CPI because it's part of core CPI, which then leads into tighter Fed policy. So we can relate that conversation back to when we were talking about what happened between 2021 and Russia's invasion of Ukraine. And that's exactly what we see happen, right? Higher oil led to increasing CPI. It's when we just saw inflation run up and up and up, and the market just kept running, which created a tighter Fed policy into the end of the previous administration and introduction to new administration. We've now are starting to see the results of a tighter Fed policy, right? Overall, another thing that I want to touch on that will be its own separate video, like the oil dollar higher CPI Fed policy breakdown. There's also going to be a video breakdown on the relationships between currencies and these instruments that we've seen. And the reason why I want to break this down is because it becomes very important to understand again the roles or the positions that specific global currencies hold. Things like why is the yen important in certain situations? When you think about Soros and what he's done with currencies, why did that happen, and how can we protect ourselves from those types of movements, or how can we benefit from those types of movements like individuals like him have in the past, right? Not necessarily meaning that we're out there to destroy a currency, but just the understanding of what are the different potentials within the market or within the forex or the currency exchanges themselves. Potentially an opportunity to again shield your money and diversify and find yourself holding money between different areas, because as a U.S. citizen specifically, let's say that at some point you are going to find yourself abroad. You might end up leaving the country and building a life elsewhere, holding a position elsewhere, right? Running a business outside of this country. What does that mean for you as a US citizen? Are you going to let yourself be double taxed, right? Because even as a US citizen living abroad, you owe, right, or on paper, due to like just regulations, you owe the US money. No matter where you're making your money. So different understandings to build for yourself if these are things that might come to mind. And you might not think about it right now, but it's always great to be prepared moving forward for whatever sort of circumstances might come to be. And that is the end of our conversation when it comes to those specific instruments. I hope I was able to give more of a debrief behind them. As always, if I didn't necessarily meet the conversation or touch on every point that you might have had questions you're always welcome to ask. You don't always have to ask them within the recording. If you want to go back into the group and you want to have a discussion through message, then we can definitely do that as well. Just make sure that whatever questions you have, that they're being put out there. Because that's my whole goal, is to get those answered. And I know a lot of the times we don't have questions because it's material that we're trying to digest. So those questions might not come a week from now, 2 weeks from now. They might come a month or beyond from now. So always know that just because we're moving on from a specific week's lecture or lesson, it doesn't mean that those questions are still that they're not prevalent anymore, right? You make sure to bring them up because this the way that it's structured, as you know, it's a domino effect, or it's a snowball into one another. So it is knowledge that is foundational that we need to build off of. So if those questions are there, definitely feel comfortable making sure that those are brought up. To wrap this up, we will just highlight or emphasize the beyond the charts reflection, stepping away from the technical side of things. I always love to make sure that we wrap up with some sort of philosophy, psychological mindset concept. This week we introduced some readings from Nassim Taleb. Again, expanded on Kahneman, Douglas. These are all kind of like urging us to consider or to understand the illusion of safety, right? Because all of these instruments that we touched on, a lot of the conversation revolves around how can you hedge and how can you shield yourself. But the reality of it is that no instrument is 100% safe or 100% without any sort of risk. So that's definitely why I wanted to emphasize these specific readings because it brings that understanding of beyond just these instruments in the market itself is that anything you do within your day-to-day life, nothing comes without risk, but how do you manage that? Or at a minimum, how do you become aware of these things? So you see within the slide these conversations and quotes, specifically from the reading. It brings up a prompt. As you go through that reading, I would love for you to keep that prompt in mind, to just build your understanding of how is this presented in relation to the markets and your overall development. When I think about some of these prompts, like after learning some of these instruments, which one feels the safest to you right now, and why might that be a dangerous feeling to have? I bring up my other example that we touched on earlier. When you think bonds like in bonds and instruments like TLT, when you think that they're relatively safe, right? Because a bond, when you're buying a bond directly, what you're doing or what you're benefiting from is the the percentage owed to you, right, for lending that money. So different bonds will have different yields. But then TLT is the instrument that tracks the bond. So you're not necessarily looking for, you're not holding the bond itself, right? Just like when you are going into SPY, you're not necessarily holding Facebook or Meta or Tesla or any of these things. So you're not necessarily getting the straight dividend from these individual companies. You're getting the benefit of the fluctuation in SPY. So TLT itself, it doesn't mean that it is an ultra safe ETF to go into after seeing how bonds have crashed, right? During an inflation, you realize that these things, although they happen not very often when you're taking a look at every single data point within the market historically, they do happen though, right? Cycles happen. So you gotta, what I would recommend is to think about where or at what point in the overall market cycle, right? Not looking at the 5 or 15 or 4 hour chart. Take a look at the weekly and the monthly charts of SPY, of Qs, of IWM. Where do you think we currently find ourselves in that overall cycle? Are we due for retracement? I mean, we've been undergoing some retracement, but are we due for some sort of big movement, or are we hitting a point where we've seen that movement already and finding consolidation, right? Things for you to keep in mind. If you do have the time this weekend, to go over some of that structure or where you see those charts currently lying, I would encourage you to bring that conversation to the group and talk about where you think the market currently finds itself. When you take a look at the assignment, beyond the reading, right? And maybe I need to, I've been thinking about this the past few weeks now. I think I'm going to restructure that assignment like wrap up section that is listed in our Discord, because I think it gets it separates the beyond the charts with then the assignment that has that is directly related to the lecture or the charts market side of things, right? But in reality, these are both the assignment, or the intent is to make sure that you do both. So I'm probably going to merge those two sections into one within the posting itself in the Discord group, just so you all are aware. Like next week, I'm going to post all of the content for next week tomorrow, and I've been having trouble with like making the YouTube link live because I can do that right now. They're done for the next 3 weeks. But when I do that, it means that it'll also be live like on YouTube itself, right? So I had them initially set for like a Tuesday release. But if you all wanted to have that ahead of time, all I need is for you to reach out to me with an email, because within like the YouTube settings, I don't know how familiar you all are, but you can give private access to a specific email. So whatever like email you use for YouTube, if you wanted that, you can just let me know and I can give you that specific private access. Otherwise, it'll just automatically release Tuesday morning at 8 a.m. Eastern time, if I'm not mistaken. Have you all take or gotten an opportunity to take a look at the ETF case study worksheet? If I'm not mistaken, I think AJ has.
I know for that when you were talking about the income and stability, I was surprised to hear you say you would have gone with because the way I was thinking about it was like the fact that realty income, they did fairly well during COVID. They maintained the dividends. So I was like, that's a plus.
Yeah.
I've at least from what I've always heard, they say never put all your eggs in one basket. And I was like, if I'm retired and I'm just looking for something steady, I don't know how good of an idea it is to have everything. And because I'm sure there were some people who had that allocation and then COVID
Mhm.
hit and they probably freaked out. So I said, I was like, if I were to do something, it would definitely need to be an ETF. That way, there's at least a little bit of diversity. That way, if maybe
Yeah.
one part of your portfolio takes a hit, hopefully the other one, will survive.
Oh, 100%. And you're completely right on that. And maybe I didn't like fully expand my conversation. I know that sometimes I have like a million things racing through my mind, but you're completely right. That is what you want to do. I think what I was probably trying to say is that I would emphasize O as probably like my priority position in wanting to capture not just the dividend, but also the potential increase in valuation. But of course, in addition to that, like you stated, you don't put all of the funds into one, right? So I probably cut myself off there and didn't really finish out that thought. But you're completely right. So I definitely encourage you all to take a look at that worksheet. It has a few different scenarios just to get you thinking about different situations that you could help others with, that you might end up or currently might be finding yourself in. And there is not too lengthy. It's just meant to be like a little warm up exercise to get you thinking about those. And that is the extent of our conversation today. But again, as always, I want to thank you for spending the time with us. I will go ahead and stop the recording now.